Hi, my name is Z with Aion Finance. Today we're going to look at historical instances of spiking oil prices due to geopolitical tensions and see how the stock market behaved in those last instances. And at the very end, I'm going to propose a couple of trade ideas. Let's begin. As an introduction, Aion Finance is all about looking at similar historical instances and looking for the best risk reward in the options marketplace. So in the last few days, we had an escalation of the Israel-Iran conflict. Oil has jumped more than 15% in the last week, which is quite a move for oil. And currently, the U.S. is considering joining the war. So the question we're going to look at is, in the last 10 years, when did the oil price spike due to geopolitical conflict? There were three major instances of this. The first one being the Aramco Attack in 2019. And over the weekend, we had a decent 15% gap up on crude oil futures, which actually sold off over the course of the next several trading sessions. Now, what was really interesting about this particular instance is it was also during the Trump presidency, and we were also in the middle of a trade war. So this candle right here, this capitulation candle right here, is when the Chinese devalued the yuan as part of currency warfare. And this correction started with a hawkish Fed. I believe this candle right here is a Fed meeting where the Fed was slightly more hawkish than expected, which led to quite a big sell-off. So a lot of the undertones of this particular market is very similar to what we are currently experiencing. So this is over the course of the next couple of weeks after the Aramco attack, when the market roll over and almost test the lows that were made a couple months ago before the U.S. and China agreed in some kind of phase one de-escalation of the trade war, and that kind of propelled the market to the next bull market. The next one we're going to look at is the Russia-Ukraine war, which started in February 2022, where crude was steadily moving up in the first month or two of 2022, which led to this climax where the U.S. imposed sanctions on Russian oil, which actually was itself the news event where oil kind of dumped the day afterwards and moved sideways for the next couple months. Now, we were in the middle of an inflationary bear market, so I don't know if this is the best analog for what we currently have today. The inflation was around 9% back in that time, which is vastly higher than what we're currently experiencing. We have some, but not. But it's deemed to be cooling at this particular moment, whereas that was not the case during this bear market. So there's a lot of volatility in this particular market. So I'm not sure if it's the best analog, but it is what it is here. And lastly, there was the Israel-Hamas war in 2023, and we had crude jump up almost 10% overnight over the weekend for that kind of news, and it rolled over the course of the next couple of months. And that was the tail end of this correction that we saw right here, where the market was freaking out between the geopolitical conflict as well as, once again, a hawkish Fed, whose pivot happened somewhere right around here, which kind of propelled us into the next bull market. So seeing this, let's talk about some actionable trade ideas on SPY, which has the best risk reward. The way we determine this is by looking at the past, taking about 5 weeks of data in the past, and we're going to simulate buying a bunch of SPY calls and SPY puts during those days at 1, 4, 7, 14, 28, 42 days out at 10, 30, 50, and 70 delta. The idea is we want to know what at the present day what DTE delta combination is best to buy/sell. So what we do is we look at the past. We look at what the realized value of every one of those calls and puts are in the past by selling to cash at expiration, and we're going to aggregate the results by days to expiration and delta. So jumping into the platform, here you see that we have a visualization of those 5 weeks that we chose, and they're generally a dip followed by the next bull market, which is something kind of interesting, except for this one here, which was in the inflation bear market of 2022. The volatility does spike quite a bit during these periods of time. So you see we get some 30s, some high 20s, etc., which is pretty interesting. Now, coming to this result grid, the way to interpret this is what is the average P&L of an option that was purchased in those 5 weeks if that option were to be one day to expiration at 50 delta call. And in the 273 instances of this, we would have resulted in an average P&L of negative 30%. So what this grid says is in the short duration calls, in the short duration, where short duration is defined by 1, 4, 7, or 14 days to expiration, calls are profitable to sell as opposed to buy. And conversely, on the put side, at the money puts that are 50 delta and 1, 4, 7, 14 days, if you were to every day go out and buy those 50 delta puts at those days to expiration, you would have made, on average this much. However, if you look a little bit farther out at 28 or 42 days, the market seems to figure itself out, and pretty much all puts are yielding negative expected value, so they're good to sell if you're willing to hold them 28 to 42 days out. However, on the call side, they're still underperforming historical averages. So what you see on the bottom row is the baseline, and the baseline is determined here, which is 2016 June to 2025, every single day, trading day during that time. The reason why I use 2016 is because that's when weeklies were introduced, and that's when liquidity greatly improved, and we get a lot more data points. So some actionable trade ideas is, I would, if you want to sell some calls, sell them 4, 7, and 14 days out, either 30 or 10 delta, either is fine. I wouldn't sell the 1 DT calls. The reason is because in bear markets or in down move, you just get these huge rip your face off rallies, which really put these like 10 delta, 1 DT kind of close-ish to the money calls in jeopardy, which is why they actually have kind of a 0% expected value. They're not expected to make or lose money. If I were to go short, definitely in the short duration, I would probably buy a 30 delta put or a 50 delta put, and I would finance it by selling one or more 10 delta puts, so maybe like a 1/2 ratio. And the reason is because these are going to be, about 20, 30, 40% cheaper than if you were just to buy one outright, and the expected value of these 10 delta puts are negative, which means that they're out of money enough such that they just have too much premium built into them. However, if I wanted to get bullish, probably the best way to get bullish is to sell puts 28 plus days out and either wheel them, hold them to expiration, because as long as you don't get stopped out of these, they are going to basically not go into the money and not pay out. And not sell calls, because even though the market kind of figured itself out at 28 days, you're going to spend way too much time burning data on these calls, and that makes them extremely unprofitable. As an aside, I did this analysis on GLD, and GLD calls in the short duration have better expectations than SPY puts. So if you wanted to go short the market, maybe buying calls on GLD is a better play than buying puts. As you can see, there are a bunch of triple-digit returns in here, one being 700%, which is basically a lotto hitting on one day. I believe there was this one day where in 2023, where gold spiked up like 2.5%, which made a bunch of lotto calls go vastly in the money, which is what's basically driving the entire P&L average of this strategy. So I don't know if you want to depend on a 16.7% strategy to execute, but it is there. So I hope you enjoyed this content. Please like and subscribe if you want to look for more of these historical analytical options content. And I hope to see you on another video. Okay, bye.